has economic theory misunderstood risk and in turn led to poor investment decisions? And do emerging markets constitute a good example of why traditional economic theory is faulty? That's the premise of a new book, Emerging Markets in an Upside-Down World, by Dr Jerome Booth, a leading emerging markets economist and entrepreneur who joins me now. Well, Jerome, accepted economic theory, what's the problem with it?
Well, there's nothing wrong with a lot of finance theory as far as it goes, but there are severe limitations. And I think the problem is in the application of theories where the assumptions are not correct. Milton Friedman once famously said that if a theory neither has realistic assumptions nor any ability to predict the future, then it's perfectly useless. And one could argue that a great deal of finance theory falls into that category. And worse, it's then used by asset managers where it shouldn't be used. I mean, one example would be the way we think about risk. Risk is a very complex thing. It's not as simple as volatility. For a lot of investors, large permanent loss is much more important than a bit of volatility. We don't really understand a great deal about uncertainty as opposed to risk, where you don't know the probability distribution of returns. We have huge prejudices. I talk a lot in my book about what I call core periphery disease, which is the idea that the core, the developed world, affects the periphery, the emerging world, but we ignore the effect vice versa. And we can't do that anymore because we live in a world where it's the emerging market central banks that hold 80% of global reserves, over 50% of economic activity.
Well, how is risk gauged in emerging economies compared to our own, for example?
Well, it's often ignored in our own. We have this phrase risk-free, which is an abuse of the English language. There is no such thing as a risk-free investment. I'm not saying that emerging markets aren't risky. What I am saying is that risk is different for different people. Unlike volatility, it's not additive. I'm also saying that it's the prejudice that people have which is often much more important. And if we perceive something as risk-free, that is a problem.
Well, I have heard you suggest that as the world has become more globalized, certain frontier markets provide the best opportunity for returns. Yet there's a call for greater regulation. Well, surely as demand increases to saturation point, the unknown unknowns become the known unknowns, and so returns decrease.
Yes, and that's a point between the difference in uncertainty and risk. I mean, I'm using Frank Knight's 1921 definition here. He talks of uncertainty as being random events where you don't know the probability distribution. He actually talks of one-off events, i.e. there isn't a probability distribution. And the investor, abhors uncertainty much more than risk, which you can ensure. And of course, this is arguably one of the key bases of Keynes's general theory, by the way. As you actually learn more, you actually turn, if you like, uncertainty into risk. But again, somebody's ability to do that may be different to somebody else's. If I have more information than you, I may actually be taking less risk. Whereas the simple way of analysing this, which is far too common, is just assume that risk is an absolute factor, in fact measured by volatility, and it's the same for everybody.
Well, could this be seen as a self-serving prophecy? For example, if investment goes to emerging economies, surely they're going to become stronger.
What I'm trying to say is not that the economic activity will follow where the money goes, because of course risk also follows the money goes. We've seen that with excess leverage and the huge blow-ups we've had, particularly 2008 and since then. There's a triple cocktail which creates some systemic risks. One is a homogeneous investor base, another is a misperception of risk, and the other one is leverage. So what I'm saying is that actually something quite different. I'm saying that one should look at economic activity on the planet, and if 50% is in emerging markets, then one should look at doing, something like 50% in emerging markets.
Well, creditors in a crisis hold the shots, and for the most part, they're in emerging economies. So is this where their strength lies?
Certainly for central banks. People often think of emerging markets, this is my core periphery idea, as the recipients of what we do. And in fact, you're right, the emerging markets are now massive net creditors. The average debt to GDP of an emerging market, is about 25%. Here in the UK, public plus private debt, over 500%. And the average for what I call HIDICs, heavily indebted developed countries, is about 250%. That is 10 times the amount of debt in the emerging market. So this brings up whole issues about things like the international monetary system, or the lack of a system. We know from history, most recently in 1971, when the system breaks down, it's the creditor central banks, the creditor nations, that actually call the shots. And we're denying that and not thinking of the United States as volatile and risky, or Europe as risky because of these high levels of debt. We know from history, however, that they're not going to get rid of those debts overnight. They're almost certainly not going to do it through fiscal adjustment, which means they're going to rob people one way or the other. And the two traditional ways of doing that are financial repression, and if that fails, inflation.
So you forecast that emerging countries will shape the world's economy, and obviously we've heard of the BRIC countries and the Mint countries, so what's next?
When Jim O'Neill came up with BRICS those years ago, I came up with almost immediately with my own, which was cement. Countries in emerging markets excluded by new terminology. The logic being that you need bricks and cement. In other words, it's just a marketing gimmick. There are another 60 countries, it's not a question of 4. There are nearly 70 countries just in the emerging debt index. And they're all very, very different, much more heterogeneous than the developed countries, by the way. Not least because they don't have this common factor of massive leverage. So I think the answer is you do lots of different ones.
Well, finally, surely there are parallels between emerging markets and Western economies. So are they headed for a financial crisis?
Yes and no, there'll always be crises, but I think there are 2 types of crises. One, a crisis that is truly global, well fine, that can affect emerging markets. And secondly, you have country-specific crises. But I think the day of an emerging market-wide crisis are completely over. And that is because without that amount of leverage and without that uniform investor base, which was highly levered that you had in the 90s and before, you don't have anything unifying these very, very heterogeneous countries. The emerging markets, as I said, not without risk. I'm not saying that. I'm saying that everything is risky, and there's a price for that risk, and you're basically being overpaid by buying emerging markets, and you're being underpaid by buying developed countries. So there has to be a balance.
Jerome, thank you.
Thank you, my pleasure.